Welcome to Smart Tech and Finance US. Today we will explore advanced Japanese candlestick patterns to master market tops, and identifying the exact peak or valley of a financial market is challenging, but these specific candlestick formations give traders a master. We will dive deep into powerful reversal signals, helping you optimize your entry points and maximize your trading profits in any. Forget basic patterns. We are focusing on complex formations that reveal the true psychology of buyers and sellers during critical market. Let us begin our journey with a highly reliable and dramatic reversal pattern known by professional traders as the tower candle. The tower top pattern occurs at the peak of an uptrend, signaling a sudden and aggressive shift from bullish to bearish momentum. It starts with a tall green candle representing strong buying pressure. The market seems incredibly bullish, drawing in many eager retail. Following this massive bullish surge, the market suddenly stalls. We see several small candles consolidating at the very top of the trend. This consolidation phase represents a crucial battleground. Buyers are losing their strength, while sellers are quietly stepping in to. Finally, a massive red candle drops down, completely erasing the gains of the initial green candle. The tower top is now confirmed. This sudden drop traps all the late buyers. Panic ensues as they rush to close their positions, accelerating the downward price movement. Conversely, the tower bottom pattern appears at the end of a long downtrend, signaling a powerful and sudden reversal to the upside. A large red candle pushes prices lower, creating widespread panic. Retail traders assume the market will continue crashing, and however, the selling pressure suddenly dries up. A series of small candles forms at the bottom, indicating that smart money is accumulating. Out of nowhere, a towering green candle emerges, shattering the previous resistance levels and signaling the start of a brand new uptrend. The key to trading tower patterns is waiting for that final, explosive candle to close before committing your capital to the market. Never anticipate the pattern before it fully forms. Patience is your greatest weapon when trading these volatile and sudden market reversal setups. Volume also plays a critical role here. You want to see high trading volume on the final confirming candle of the tower. This volume spike validates the institutional participation. It proves that major financial players are driving the new trend, ensuring a. Now that you understand the aggressive tower formations, let us move on to a pattern that highlights extreme market indecision and confusion. The high wave candlestick is a fascinating formation characterized by a very small real body and incredibly long upper, and these long shadows tell a story of extreme volatility. Both buyers and sellers fought fiercely, but neither side could. When a high wave candle appears after a prolonged uptrend, it serves as a massive warning sign that bullish momentum is dying. The market is essentially losing its sense of direction. The previous confidence of buyers has vanished, replaced by hesitation and growing. Similarly, finding a high wave candle at the bottom of a downtrend suggests that sellers are exhausted and a reversal is imminent. It is crucial to remember that a single high wave candle does not guarantee an immediate reversal. It simply indicates market confusion. You must wait for the next candle to provide confirmation. A strong close in the opposite direction validates the impending trend. Trading the high wave requires discipline. Entering too early can result in getting chopped up by the lingering volatility of the market. Always look at the preceding trend. A high wave in a sideways, ranging market holds very little significance and should be ignored. Context is everything in technical analysis. The location where a candlestick forms is often much more important than the candlestick. By mastering the high wave, you can protect your profits by exiting trades right before the market abruptly changes its overall direction. Next, we will explore two powerful but slow-moving reversal patterns: the dumpling top and its bullish counterpart, the fry pan. Unlike the aggressive tower patterns, these formations represent a slow, gradual shift in market sentiment. They take significant. The dumpling top consists of multiple small candles that slowly curve upward, forming a rounded peak resembling a traditional Asian. This gentle curve shows that buyers are slowly losing their strength. There is no sudden panic, just a gradual exhaustion. As the rounded top completes, a bearish gap down usually occurs. This gap confirms that sellers have finally taken absolute mark. The beauty of the dumpling top lies in its sustainability. Because the reversal was slow, the ensuing downtrend is often very steady. The fry pan bottom forms after a long downtrend. Small candles create a rounded shape, curving gently toward the chart bottom. This indicates that selling pressure is slowly evaporating. The market is quietly stabilizing as smart money slowly accumulates. The pattern is confirmed when the price suddenly gaps up away from the rounded bottom, signaling the start of a robust uptrend. Trading these rounded patterns requires immense patience. Many amateur traders get bored and abandon the asset before the loop. Remember, slow and steady transitions often lead to the most reliable and long-lasting market trends. Do not underestimate. You must look for gaps. The breakaway gap at the end of a dumpling top or fry pan bottom is absolutely essential. Without that final gap, the pattern is incomplete and prone to failure. Always wait for definitive confirmation before risking your... Now, let us discuss a crucial concept that separates professional traders from amateurs. We must analyze candlestick clusters. A single candlestick provides a microscopic view of the market. It shows the battle between buyers and sellers over a short time frame. However, a cluster of candles reveals the broader war. It gives you the macro perspective needed to understand the true market narrative. When you spot a tower top, high wave, or dumpling top, you must analyze the surrounding candles to gauge the overall momentum. Are the preceding candles showing strong momentum or gradual exhaustion? This context dictates the reliability of the reversal pattern. Furthermore, you must always consider the prevailing market trend. Reversal patterns are only effective if there is an actual trend to reverse. A bullish reversal pattern like the fry pan bottom is meaningless if the market is already in a strong, established upward trend. Always zoom out and look at the bigger picture. Use multiple time frames to confirm that your chosen reversal pattern aligns with reality. Combining candlestick clusters with multiple time frame analysis dramatically reduces false signals and significantly improves your trading. The final and most important technique is combining these advanced candlestick patterns with key levels of market support and resistance on charts. Candlestick patterns alone are not magic. They are simply behavioral footprints. Their power multiplies when they occur at significant. Imagine spotting a massive tower top formation, perfectly aligning with a major daily resistance zone. This creates a high probability. The resistance level acts as a structural barrier, while the tower top provides the behavioral trigger indicating that the barrier will hold. Similarly, finding a high wave candle bouncing off a critical support level gives you immense confidence that the bottom is finally in. This confluence of technical factors is the secret of professional trading. It turns a mediocre trading strategy into a highly profitable. Let us look at a practical example. Notice how the market approaches this historical resistance level with strong, aggressive bull. Suddenly, the momentum stalls. A dumpling top begins to form right at the resistance zone, showing a slow, agonizing death. Finally, a bearish gap down occurs, confirming the dumpling top and rejecting the resistance level simultaneously. This is By waiting for this exact confluence, you minimize your risk and maximize your potential reward, which is the ultimate goal of trading. You can place your stop loss safely above the resistance level, ensuring that you are protected if the market suddenly behaves irrationally. Always remember that trading is a game of probabilities. No pattern works perfectly every single time, regardless of how beautiful it looks. Risk management must always be your top priority. These advanced candlestick patterns are tools to give you an edge, not practice identifying these formations on historical charts before risking real money. Train your eyes to recognize the subtle nuances of look for the tower formations, the high waves, the dumpling tops, and the fry pan bottoms across various assets and different. Over time, you will develop an intuitive feel for market momentum and be able to spot these lucrative reversals with absolute precision. The financial markets are incredibly complex, but understanding the psychology behind Japanese candlesticks helps you navigate the chaos. We have covered a lot of ground today, from aggressive tower reversals to the slow, steady transitions of rounded tops and bottoms. By integrating these patterns with market context and structural support or resistance, you are now equipped to trade like a seasoned professional. Keep studying, keep analyzing the charts, and never stop refining your edge. The market rewards those who are patient, disciplined. Thank you for watching this comprehensive guide on advanced candlestick patterns. We hope this knowledge empowers you to achieve your trading goal. This is Smart Tech and Finance US, signing off. Subscribe for more expert trading insights, and we will see you next time.